Self-employed homebuyers are ignoring one of the most powerful loan types created just for them, and the consequence is losing out on their dream homes. Non-QM loans are specifically designed for self-employed buyers who can't show traditional income docs, yet almost no one even knows they exist, let alone uses them. If you go the conventional loan route instead of non-QM, you're likely getting denied, overpaying, or missing out entirely, simply because you're using the wrong financing approach. I'm Andrew Russell, owner and founder of RCG Mortgage, four-time winner of NAMBY Broker of the Year, top originator across the country, and I specialize in working with entrepreneurs, business owners, and self-employed clients on achieving real estate riches through the right mortgage products. One of my top agents, actually, in one of our casual conversations on the weekend, rocking out my oldest kid on the soccer field, obviously took the call, got to take the call, unfortunately, even when you're watching, shout out Daniela playing soccer. And speaking to this agent, sounds like they had a $2.5-ish million sale, $3 million sale, really cool property, in the Carolinas. For whatever reason, the client, who had a ton of money, great credit, great job, all the good stuff, they were working with where all their money was parked, which is actually one of the big banks, right? One of the big investment firms who also does mortgages. And although sometimes they give away the house, or they give these sweetheart interest rate deals, they oftentimes are either late to the closing or they can't close at all. And the same kind of fell true for this specific buyer, where it should have been a super streamlined transaction and they were a month into it, no closing date in sight. Finally, the loan officer at the investment firm said, hey, we're probably not gonna be able to close for a couple months. And if we are, I'm not really sure if we actually will be able to deliver this closing on time and even close in general. But the interest rate offering we're doing that we locked in is really good. But you have the best interest rate in the world locked in. If you don't close in the house, the house is all for nothing. So I actually, they referred the client, or this agent referred the client to me, spoke to them, told them straight up, hey, listen, our interest rate, which will probably be more, whether we're going to do an investment, a non-QM loan, or we're going to do a bank statement loan because they were self-employed, or maybe do a jumbo loan because of the tax returns. I had to do a forensic. Our interest rate is probably going to be a little bit higher. It could be a quarter, it could be 0.5% higher, but I can guarantee a closing in a handful of weeks versus a 60-day maybe. I can guarantee when I say a big fat yes, and our team's, tells you that you're good to go, you can close in 2 weeks. So the client said, all right, listen, for me, I know eventually the rates are going to fall, probably going to refi in the next handful of years. I'd rather the house before, maybe next year, if it doesn't sell this year, they sell it for even more money as the market's going up in the Carolinas, it seems. The 2-week close sounds good, Andrew. Let's rock and roll. So what we did was, first I did another forensic, because you never know. Just because another company, even these big companies, right, these big investment firms where clients have millions parked with, doesn't mean that they do well on the mortgage side or communicate as well as, say, we do. So I took a forensic and I saw they probably never qualified the full doc route, right, for the jumbo route, meaning, this specific, client I was working with went from W-2, then opened up a corporation, went self-employed. The corporation wasn't open for 2 years. There's so many guidelines. Like if you chat GPT this stuff, even ChatGPT will tell you, if you go from W-2 to self-employed, especially it's you haven't had 2 years filed self-employed returns, it gets super problematic. So I decided, hey, maybe it's best if we do a non-QM loan. I compared the amount of money he was putting down the loan size for a jumbo loan versus non-QM. Turns out non-QM priced the same, which means better loan for him, less paperwork, everyone's always happy. And then from there, which non-QM loan type? We had asset dissipation, asset depletion. We had a program where if he was getting, let's say, a loan of $2 million, which is what he was getting, if he had, follow me, 125% of that loan sizing, 125% is 2.5 million. So after he closed, he was buying it for 4, putting down 2 million, loan of 2 million. As long as he had over 2.5 million in assets or more, which he did, he had access of, monies in the market and different investment accounts. He qualified. No income. That's literally it, by the way. Let's start over. Did you hear what I said? He had 2.5 million left over, $2 million loan, and that's all we needed. He qualified. 6 months proof of that asset. That's all that was required, which was just a couple monthly statements, and you're good to go. No income questions, none of that stuff. So we were able to streamline the process for him, get him pretty much a similar rate. It's a little bit higher. We'll talk about in a little bit some pros and cons, of course, always. But we were able to, if you just followed the chronology, he had no idea if he was going to close in 2 months. On a Monday, we sent him the application and locked his interest rate for 30 days, went over everything with him. By Tuesday, his loan was submitted to underwriting. On Tuesday, we ordered a rush appraisal, which was guaranteed to come in by the following Monday. They got an appraiser to do it and actually send it in quicker than that time frame. And then by the end of that week, The appraisal report was almost in and being worked on. The title report was already done because he had been in process for a month with another lender, as we alluded to. So by the following Monday, we had the appraisal, we had title updated with the new lender information we were working with, and all the items we needed from the client. We submitted for the clear to close. We got the clear to close by Wednesday. Because we locked the interest rate on a Monday, we're able to order the closing disclosure, which is 3 days typically, 3 business days before closing. We had that ordered the following Monday, so we can close as soon as Thursday. We ended up closing right as I said, right on Friday, and we were men and women of our words at RCG Mortgage, and we actually closed on time for the expedited process as we promised, but that's because we put him in the right mortgage type. Sure, could he have qualified maybe on the self-employed route, not being self-employed for 2 years? In a jumbo loan, they're going to ask for dissertation papers. They're going to put the CPA through hell. It's going to be brutal. Could that have worked? Maybe, but the fact of the matter is, you have 2 processes we could have followed is the path of least resistance. A, which was getting 6 months bank statements, nothing else, no questions, guaranteed, awesome, which he took. Or B, we could have put him through hell, his CPA through hell. Maybe the lender does it, maybe they don't, maybe they might. And people want to live in certainties. So because of this non-QM product suite that we offered, and because of this streamlined program that non-QM allows, this asset program, which we'll talk about in a little bit, the client was super happy, and nobody will ever not enjoy an expedited and efficient process. But of course, so is, hey, Andrew, you always make it sound so easy. What's the catch? There is no catch. Just remember, we're going to go over a little bit. What is non-QM versus QM? Non-QM is non-qualified mortgage. And the way that they typically qualify mortgages, Fannie Mae, Freddie Mac, FHA, VA, USDA, portfolio, jumbo, government mortgages, the way they qualify them has always been very different, especially if you're self-employed or retired or have a lot of assets in the bank, maybe your income's all over the place or not consistent. The non-QM mortgages offer a different vantage point, a different way of figuring out the income and qualification, all now with a similar interest rate. Or, hey, Andrew, similar rate, you're pulling my chain, if that's even a saying anymore. You're pulling my leg, I don't know, yanking my chain, one of those things. Regardless of the chain, yes, sometimes non-QM versus the vanilla, or a credit union or a big bank, the rate's 0.25% higher. But the fact of the matter is, what is more important to you? The savings in rate, or maybe to get that rate, you pay a little bit more in closing costs on the non-QM side, or actually closing in a way where you didn't pull your hair out, where, the seller and everybody isn't, throwing the haterade, so now you're out of contract, time of the essence, or they're threatening to keep your deposit. There is such a thing in life as shopping around almost to your own demise. So while sometimes the rate is a little bit higher, the closing cost is a little bit higher, you always have to weigh, peace of mind. Are you going to keep this mortgage forever? Are you going to refi potentially in the future? So it's marry the house, date the rate type thing, super popular. But I can tell you non-QM versus some of these other loan programs is a little bit more expedited. Or, hey, Andrew, I'm sure your closing costs, you charge exorbitant fees. I've seen all the movies, brokers in all these places, they charge fees, through the yin yang. No yin yang there. So we actually don't charge exorbitant fees. On the wholesale side, the broker side, yes. Do people offer out something at $1.01, we're getting for $1, and that's how brokers make money? Or we offer it out at $1 and charge a fee for that specifically? Of course, there's different ways that we're compensated, lender paid or borrower paid, not to get in broker compensation, but we are performing a service. Just like if you want to get a Lexus, they're not giving you the Lexus without, a small little VIG attached to it. It's the same thing with us. But the good news is brokers have now, and it's been proven by the data, by the science, we are the low-cost provider. We typically save clients on rate, closing costs, or both. So now, more than ever, going to a broker saves you not only dollars and cents, it might even save you the house. All right, so the acronyms get super confusing, right? You have non-QM, you have QM. So I'm going to go into right now non-QM mortgages. What are they specifically? We're going to talk about the bank statement program for a primary purchase, the P&L program. We're talking about that asset-based program, which I just went over, which sounds too good to be true. It's not. I'm going to show you with one illustration on how I help my client. I'm also going to show you one of the more popular investment opportunities, which is the DSCR mortgage. Before I get into this, guys, make sure first, go in the description, click the link. We have non-QM versus QM, just a quick guide for you guys, just to know the differences and which makes the most sense for you. Make sure you download it. Our team works so hard on it. Know when you download it, we're not going to stalk you and text you and email you. I don't think, at least. But truthfully, go in our description, click the link, download our free guide. It's amazing, guys. And if you're in the market to either purchase or refi, and you don't know if non-QM or QM or any of this stuff makes sense for you, download the free guide. It's definitely something you're going to want to have. All right, guys. So our favorite time, it's time for some knowledge transfer. So I'm going to go over non-QM. What does it mean? What is even a QM? right? So when you think QM, think of like old school mortgage, right? You think of Fannie Mae, Freddie, not to write a million things out, right? FHA, VA, USDA. Think of jumbo loans. Just to keep it simple, these are probably the product suite for QM. What does it mean? The way they qualify you, especially if you're self-employed or some of these more exotics, right? If you're self-employed, they're looking at your tax returns. They're putting you through the ringer. There's a ton of guidelines. The deeper you go sometimes, the more they ask for. So that's what we as mortgage professionals, we always dealt with on the qualified mortgage side. So it's like the coolest thing in the world, right? Here comes non-QM. So the non-QM side, which we're going to go over, typically, now remember guys, are you buying as primary? Are you buying as an investment? Big difference. Primary, you say you're going to move in. Got to move in. Just move in. Got to do the thing and move in. That's primary. Investment, you say you're not moving in. You say you're going to rent it. Don't move in, guys. Don't do it. Don't be the person that moves in. You're not supposed to move in. Why? Because this is a very dicey, topic in the industry right now, especially with what's in the news as of late. If you say you're going to move in, you have to move in because the way they qualify you for mortgage is based on the fact of you moving in. Now, if you say, and not renting it, if you say and especially the interest rate, they give you a better rate. If you say you're not gonna move in and you're gonna rent it and you actually do move in, it's the same thing. You've qualified for a mortgage that isn't accurate and you knowingly did that. So just make sure when we talk about some of these, is it a primary? You're moving in, typically within the first 60 days. They want you to be there for at least a year. Listen, do things happen? Maybe the block isn't the best. Maybe you got married, have kids, whatever it is, and you want to keep it as an investment or sell it and get something else. Of course, things happen, but you're really on the dotted line. You're going to move in within 2 months, 60 days, and you're going to live there for about a year. Investment, you're going to rent it. You're not going to live there. Even if it's a 4-unit house, and to you, if the 3 units in rent cover the mortgage and you think you'll live there for free, but you're living there, it's a primary. It's not an investment. So these are things you have to be honest with yourself, but also the banks, they actually do care. So the first side, if you're thinking of the non-QM product suite, the non-QM product suite, probably the most popular of the first 2 mortgages that came out were the bank statement loans and the DSCR side. The GOAT of all investment mortgages. So on the bank statement side, so when you think of qualified mortgage, and these over here, typically at a minimum, they'll look at 1 year of your tax returns if you're self-employed. They want to see the business typically open for more than 2 years. More often than not, they'll look at 2 years tax returns. Now, if they look at 2 years, it opens up a lot of can of worms. So they look at the profit, not the revenue. Your revenue year over year, if you think of 2023 and say 2024, you wouldn't have filed 25 because we're in 25. But if we look at 2023 and 24, right, if you think revenue, expense, profit, that's what tax returns look like. Revenue, expense, profit. They care about your profit. Now, year over year, they want to make sure that it's the same or going up. Because if it's going down, especially because they can't look real time during the year. So say this is right now, October 2025. We really don't know what's going on during the year because we don't have a filed tax return for during the year. So if it's going down over 20%, there are some lenders that won't even allow you to use the income at all because they think it's just going to go away, poof, disappear, right? So, and even year over year, if your profit goes down, but the revenue went up, who cares? It doesn't matter what you bring in. It matters what your profit is because it's your expenses, right? That's a different variable. Maybe your expenses went up as well. Higher revenue, higher expenses. They just want to make sure and look at your profit. So this has been the QM tax return self-employed review forever. Now, here came this program a little bit before the pandemic, off the bank statements. What we do is it started with a 24-month review, which is a lot. I mean, listen, 24 bank statements, just annoying for a client. Now, the big thing is 12 months. So we'll look at the last 12 months and we'll look at the revenue coming in. We will make sure that it is actual business revenue. So over the last 12 months for any business to figure out income, no more tax returns. We're going to look at 12 months bank statements. This is for non-QM, of course. So our non-QM products. We're going to look at the last 12 months of your bank statements. We're going to see month over month. What's the amount of revenue coming in? Is it similar, not too choppy over the last 12 months? We're going to add all that together, and that's your yearly revenue. From there, we're going to cut it in half. So we're going to add it together, right? So you're going to have your revenue. What percent of the business are you from an ownership perspective, do you 100% own it? Easy enough for this illustration, but you're 100% owner of your business. You own a dry cleaner, right? You're 100% owner. Over the last 12 months, the dry cleaner has $50,000 a month of deposits. So $50,000 a month, give or take 40, 60, 55, 45, right? Give or take on average, it's about $50,000 a month. So for the year, that's $600 for the year, right? So $600 for the year, because you're 100% owner, they're going to give you credit for half for income. So $300 for the year, which is $25,000 for a month, for the monthly income. It's that simple. We look at 12 months bank statements, check the revenue, make sure it's coming in, it's business related, it's not a loan or personal monies being commingled. Look at that revenue. Do you own the business at 100%? And at a minimum, we're going to give you credit for half of that revenue as income, which is cool, because maybe on the tax return side where we did a big fat no, maybe that $600,000 of revenue, maybe there was $550,000 of expenses, which would have net to $50,000 for the year, which would have been $4,000 for the month. So instead of $4,000 a monthly income to qualify for a purchase, which I can tell you at least in New York, it's just never going to fly these days, now you get $25,000, which is like 6xing your purchasing power. So that was the number one product that came out first in this non-QM suite. And it was super cool. You know, it started with higher down payments, 25 or 30%. Now you can get as low as 10% depending on the state. But the bank statement program was the first one that came out and is super popular. Second one, kind of concurrently, was the DSCR loan. Now this is on the investment side, not primary, right? The bank statement side typically is on the primary side. The DSCR side is just very simply, if you're buying an investment property, putting down at least 20%, give or take a little bit more, they're comparing the market rent to the monthly payment. So if you had $1 million sale price, 20% down, $800,000 loan, 7% rate, 7.5% APR. You have a $5,600 a month payment. Maybe with taxes and insurance, you're another $1,400 for T&I. So that's $7,000. So you have a $7,000 a month payment for this example. Just real quick, not official, but very close. Perfect for a YouTube video, right, guys? All right, so that's $7,000 a month. If we come back over here, so say this is a 2-unit property, which means you have 2 separate legal units to rent. Say each unit commands $3,500 a month in rent, right? So that's 1, that's 2. You add that together, it's $7,000. So it's comparing what I write, the rent to the payment, $7,000 to $7,000, and they want to see at least typically a 1-to-1 or better, meaning that $7,000 payment, that the rent is the same and or higher, which in this example it is. So it qualifies. So it's that simple, right? This loan came out, and if you think of all these loan types, FHA, VA, they don't allow investment. Jumbo and Fannie and Freddie, the guidelines are a little bit more stringent. We're looking at all the paperwork. We're checking out your tax returns. Maybe you wrote some stuff off. It's not going to fly with them, believe it or not. Maybe they want a little bit more money down. Maybe the qualifications with less money down just don't work for you. So the DSCR side took the market by storm. Unfortunately, during the pandemic, kind of came off the shelf, came back, and now the interest rate offering on the DSCR side is very close to what it is on the conventional side. But with that said, this is the qualification. You know, it's basically purely on the market rent based on the price. Now, there's a lot of different variables here, guys. Typical down payment is about 20%. You know, typically it could be a little higher, 25, 30, 35%, because it's all on the market rent versus the payment. It allows for less than a 1-to-1. You can go down to, say, 75% of the payment with the market rent, believe it or not. Maybe the rate's a little bit higher. You know, if the going rate is 6.5 for conventional, maybe instead of 6.75 or 7% for DSCR, goes to 7.5, maybe even 8%. Or if you put a little more money down, it's no income. Doesn't even ask what the market rent is, but it's higher. Why would you do that? Not really sure, but there are specific examples. Maybe you think you're getting a good deal. You don't care what the rent is, where you want something where the market rent doesn't have to cover. So there's a lot of variables with the DSCR side. I've done a ton of videos around this, so make sure you check out the page and see some of those specific videos on DSCR. But on the non-QM side, the first 2 that kind of took it by storm were the bank statement program and definitely the DSCR side. Again, the bank statement was for primary, whereas going off the 12 months bank statement, such a cleaner review than looking at tax returns, putting the CPA and the client through hell. The DSCR side on an investment, typically a 1 to 4 unit, at least initially. Now you can do 5 or more units, which is cool. 1 to 4 unit or a condo specifically, market rent versus the actual payment. It's a real quick illustration, but this is something that was very popular. Now the third is the P&L side. So if you think of what a P&L is, it's through the client with the CPA or an EA or a PTIN. It's, hey, in the last 12 months, what was your revenue? What were your expenses? Somewhat itemized, not all that granular, but still in various buckets. And what was your profit? The reason this is good, and you wouldn't do a bank statement program that has a little bit better pricing typically than a P&L program, profit and loss program, that's what P&L stands for, is because what if your business is seasonal? So if your business is seasonal, think of 12 months. So as an example that I always use, it was super popular to go to a local photographer and get these Christmas pictures, and everyone was taking them, and it's like magic with you and the kids. You know, my two daughters and Santa, was magical. Then all of a sudden, everyone started going there. Then all of a sudden, they started doing Easter. Now I think they do Father's Day. I probably went there a handful of times for Father's Day. I'm sure I went there for other holidays I don't even know exist. It was the coolest experience. But if you think about it, Christmas pictures, you pay for them up front. So if it's Christmas in December, you figure December, November, maybe October, those 3 months, they're getting revenue to their business because it's a business. Then you figure Easter, if it's around April, March, April, they're getting revenue. Then you think of some of the other holidays. So maybe January, February, and portions of March, they make $0. Maybe July, August, September, parts of October, they make $0. So if you did a bank statement program and you look at the last 12 months, an underwriter who makes the decision of a big fat yes or big fat no on the lender side for these programs would say, no, your income isn't consistent. I get the nature of your business, but you're not making money on some of these months. Like, for all I know, you're going to be out of business. No, you're declined. So profit and loss program would be great for them because over the last 12 months, it'll aggregate their revenue. Say they made $1 million, $80,000 a month if it was a bank statement program, but it's not, remember? Each month isn't necessarily consistent. So over the last 12 months, all in, whether it was 4 or 5 months of collecting revenue or 12, who cares, right? The lender's not going to see or know. In the last 12 months, they'll work off the P&L, $1 million in revenue. Great. What were the expenses? Maybe the expenses were $300,000. So their true profit was $700,000. So that's exactly what they're going to go off of with no monies taken out. This is something that they're going to go off the P&L, depending on what percent owner they are, of course. But this is just a clean thing that was invented where if the bank statement program, these are like the 1-2 initial punch, right? If that didn't work, maybe there's a reason why. Maybe if the income is not consistent because of seasonality or whatever it is the nature of the business, we'll do the P&L program, a profit and loss program, where we're just going to go off of what the revenue and expenses and profit was, not look at any bank statements, believe it or not. I know it sounds crazy. You don't even need to supply bank statements and prove this out. You're going to get it from your tax preparer, and this is what we're going to go off. And now, as in the example of my story, the fourth option, right? Something based on assets. So you yourself know, are you the type of client that has a ton of money in the bank, ton of assets, could even be crypto, could be anything, an asset, something, checking, savings, 401k, IRA, stocks, bonds, crypto, who knows? Can't be, a whole garage full of old Lamborghinis or Ferraris. It's actually something that's tangible, and now, believe it or not, cryptocurrency is being allowed. So the asset side, maybe your income's a hot mess. Maybe you flip houses and your tax returns are all over the place. Whatever it is, there's always, like, maybe you change jobs or you go from this contracting job to another, whatever it is. Maybe in mortgage, vanilla QM world, it's hard to work with your income type. On the non-QM side, if you have a ton of money left over in the bank and assets, this is something that could be super viable. So in the case of, and typically this could be for a primary, it could be actually for an investment. So in the example that I went over before, if you just follow, you had a $4 million sale price. The person had a ton of money in the bank. He put down $2 million on the buy, so it's $2 million loan. So this program, just as one of the examples, if you have 125% of the loan in assets in the bank left over, you actually qualify. So what's 125% of that? It's $2.5 million between friends. This person had way over that. They had like a $10 million. I almost told them, it's like if you're going to play blackjack, you have a $10 million chip, right, to play blackjack, which is a lot. So that $10 million chip, gave them $2 million for the down payment they were doing, which is 50%, some money for closing costs, plenty of money left over, so they had a surplus over that $2.5 million. But then they qualified. We didn't need any other paperwork, guys, nothing. No tax returns, no explanations, no high fives, but everyone loves high fives, right? We just needed their bank statements to show they had over 1.25 of that amount, 125%, which they did, and then they qualified. Now, this is kind of like a newer program, but it's amazing because what it does is it rewards those that have a lot of money left over in the bank and reserves. And the interest rate offering was almost just as good as they were getting from their actual investment side, the investment banking side, that was kind of putting them through a more difficult time. This program has definitely taken the market by storm as well. All right, guys, if you want to see how a self-employed client qualifies for a mortgage, make sure you watch my next video. I'm self-employed. How do I qualify for a mortgage? I'm going to walk you through all the different loan types, the exact qualifications for all, and how you go from just confused client to actually qualifying. So make sure you watch my next video. We're going to go over all the ways to qualify for a self-employed mortgage.